All right, guys, Visa stock is up 17% year to date. In the last 5 years, it's up 67%. The last 10 years, 409%. Guys, Visa is an incredible, incredible business. This thing spits off so much cash flow. It's done such a great job. It is the brand of brands when it comes to credit cards. Visa is there. Now, they don't have the luxury that American Express does, but they are incredible. So if you're watching this video, we're going to go over a lot of things about Visa. We're going to go over the numbers. We're going to go over the 8 pillars we have for them. We're looking at analyst estimates, and then we're going to use our very popular stock analyzer tool to determine a price to pay for Visa based on our assumptions about the future, okay? Now, if you're a beginner or you're an advanced investor, we have something in this video for all of you. So listen to this entire video, watch it all. It's gonna be great. You're gonna get a feel for our process. So let's take a look at Visa right now and look at some of the high level items. So it's a $426 billion market cap business, all right? Guys, Wednesday, June 28th, 1 p.m. Eastern time, free webinar on real estate. Our channel loves real estate. We just haven't made many videos on it. We're trying to restart that now. We have a great real estate calculator on our software. Free webinar. Sign up at the link below. Super easy. You're going to love it. Thanks very much. Don't forget to sign up. So in terms of market cap, that's the share price multiplied by the number of shares outstanding. Before we go further, I also want to look at this. Enterprise value. Now the difference here, 457 to 426 is essentially their debt, because enterprise value is buying all the shares plus their debt less their cash. So basically you own the entire company, right? All right. So guys, if you're new to watching this channel, we're a value investing channel and a true one. We don't just say it. We believe that every investment is the present value of all future cash flows. And when you're buying a stock, you're buying a piece of a business. We want the stock prices to go down. That's an opportunity that if we find a great business at a better price, we want to buy it. That's the very big key here. It's about the emotion and the mentality going forward and buying stocks. The numbers are the easy part. The hard part is sticking to your guns when the world looks like it's coming apart, especially on a specific stock. So we're here to help guide you through to that. Let's talk about some news for Visa. Let's see what's in the news for them. All right, 2 pieces of major recent news for Visa. 1, they have partnered the launch of Africa FinTech Accelerator Program. Guys, I've been saying this for a while. Africa is the next big growth frontier. Got a lot of people, highly poor, but it's going to be a place where a lot of factories can be built. There are a lot of issues with Africa, don't get me wrong, but remember what China was 50 years ago, 40 years ago, 30 years ago, what India was. And as those countries get more and more wealthy, we're going to have to find another area to go invest a lot of money into. Look at Kenya. I just read an article the other day about Kenya, how it's spending a lot of money on startups. It's incredible. And in the picture was a big building with the name Oracle on it. I'm looking at this thinking to myself, there we go. Africa's got a lot of potential. Second piece of news, Visa is said to near deal for Brazil payments provider Pismo. Guys, they're expanding. They want to control this payment market. You know, Visa controls a lot of the payments in the world. It's accepted everywhere. That's the standard. So it's a great company with a lot of potential. Now, a couple of bull and bear cases for Visa. 1, bull case. Estimated that by 2030, 65% of all worldwide point of sale transactions will be done digitally in general. And if who's the biggest provider of that? Visa. So it's going to be a huge tailwind for Visa. Between Visa and Visa Debit, they control 61% of all these network transactions. Boy, oh boy, 61%. Actually, that was going to be higher, to be honest with you, but that's a huge number anyhow. That's a massive number. Now, of course, not every company is going to have, you can't have all rosy picture. So a couple bear cases. They're facing antitrust lawsuits for, obviously, they control the market for fees. So people are going to sue them saying, hey, you control so much of this that you can basically take advantage of things. Understandable. I mean, I get that because they do control the entire market. Everybody uses Visa. In our companies that accept credit cards, the vast, vast majority is Visa. And of course, a temporary bear case. Everybody's worried about a looming recession. Everybody's worried about people cutting back their spending. Visa is going to be hit because of that. Now, the benefit for something like that is it might be an opportunity because clearly a recession won't last forever. It may be an opportunity to buy a great company at a better price or a great price. That's the key there. So again, even on bear cases, if it's temporary, like the second bear case was, we should hope for a recession so that way transactions do go down and the market overly dramatizes that reaction, the stock falls further than it should, and you can buy cheaper shares. But the question is, what is a cheap share for Visa? Look at this chart on the screen. This is the global network car brands in the US for 2022. Look at the right side in terms of purchase volume. Visa, MasterCard, Amex, and Discover. It's an absolute huge difference. These guys are a great, great moat. I think the two moats here are Visa and American Express, because American Express has the luxury brand with it. But this graph shows you Visa's dominance of that market. So let's go continue on with our more basic information on Visa. All right, so last year's free cash flow is $18.2 billion, the 5-year average of 13.7. Okay, that's pretty big difference from last year versus the 5-year average. Now, they do pay a dividend of about 0.8%. Now, the key here, guys, if you're new to the channel, we don't just trust the dividend. We need to make sure the dividend can be afforded. And that means comparing it to the free cash flow. That's why we put the dividend right under the free cash flow. Dividends paid of $3.5 billion, well under their $13.71 billion 5-year average. We want to make sure that this is no more than half of the 5-year average free cash flow, depending on the company. This is well below half. This is about 25% of it. That's a great. This dividend looks very safe in my opinion. Guys, look at this. Bottom line margin, 51%. That's after overhead costs, that their building costs, their everything they have to do, plus paying taxes, 51%. Their gross margin is about 80%. Huge numbers. Now, return on invested capital. Last year, they did 23%. The last 5-year average is 19.5. So what does this number mean? The return on invested capital is the return that they get on the money invested in the business. You can invest in a business two ways, debt and equity. This shows they get a huge return on that. This is an indication of a moat. The higher this is, and the longer that it's high and maybe increasing, shows a bigger and bigger moat. That's what's key to the return on invested capital. This is what all value investors love to talk about. But it's very important that you understand that concept. It is a little confusing to start. But basically, if you have $5 in equity, $5 in debt, your total invested capital is $10. If you make $2 on that, your return on invested capital is 2 out of 10, which is 20%. And if you can do that over and over and even figure out a way to increase it, you're probably making your moat bigger and bigger. And if you see in our stock analyzer tool, it will show you the return on invested capital over the last 5 and 10 years. And look, it's getting larger. That's awesome. So it shows that Visa is probably getting a bigger and bigger moat as time goes on. So I guess another question I always ask people from a high level. So look at the market cap, $426 billion. If I gave you $426 billion today, would you be able to compete with Visa? Probably not. And that's another indication of a moat. You probably can't compete with Visa by literally writing a check to restart them with the same market cap. That's awesome. All right, let's go look at a few other things here. Let's look at their 8 pillars. Boom. All right, we have 2 X's and 6 check marks. So remember, if you have our software, you can edit the 8 pillars, up to 12 of them, and there's about 4 quadrillion different versions of variations of the 8 your pillars with 12 of them. So look here. The 5-year PE is 33. The 5-year price of free cash flow is 31. That's our only X's. But remember, just because the PE and price to free cash flow is high doesn't mean the stock is expensive. You should pay a premium for a faster growing company with a high return on invested capital. This company we've already shown has a very high return on invested capital and growing. So this company should get a premium. The question is this too much of a premium? I don't know. That's what we're going to use our stock analyzer tool for. But high return on invested capital, buying back some shares. I don't know how I feel about that. Their current PE is 27. Their 5-year PE is 33. So maybe it's expensive. Remember, we don't want companies buying back expensive shares. Buying back shares is awesome as long as the stock is cheap. You're giving your investors more and more of the revenue and profit and free cash flow as time goes on when you buy back cheap shares. But if you're buying back expensive shares, you're misusing the capital in the business. As an investor, you have a claim on that money. You want the company to be good financial stewards. You want them to invest the money at a great rate of return. So when they're buying back their own stock, if it's expensive, they're not doing that. That's the problem. So just remember that going forward. Cash flow growth of 6.3 billion, net income growth of 4.7. I like seeing this. Their cash flow growth was higher than their net income growth. I love that. Revenue growth, 9.3 billion. Look at this. So basically they converted 66% of their revenue growth into free cash flow. That's incredible. That's absolutely incredible. And finally, their debt, very low. They can pay it off very quickly. But we saw that before where they're looking. Their all-time high was $252 almost 2 years ago now. Almost 2 years ago. And their 52-week low was 175, and they're currently at 226. So they're getting within 10% of their all-time high. All right, let's look and see what the analysts are saying about the company. They're expected to make $8.63 per share for the fiscal year ending September 2023, and analysts expect $14 in 3 or 4 years. Now, guys, this is great growth, double-digit growth. I love it. But remember, analysts have a bias. They want to make sure that they make these companies happy because a lot of them have investment banking and they want to make sure these guys are on their side. So look at this, but don't take it as the Bible. Just take it with just look. I just do what I do as I just look at it. I'm like, okay, they're expecting double-digit growth in terms of earnings. Now for revenue, also basically double-digit growth except for the last year, from $33 billion this year to $44 billion. Guys, I always ask these 3 questions about a company. 1, do I think this company will be around for the foreseeable future? Visa will be around for a very long time. I'd be very shocked if it wasn't. 2, do I think they'll make more revenue and profit as time goes on than they do today? Absolutely. Absolutely. 3, can I pay a reasonable price for the company today based on my assumptions about the future that gives me an adequate return on the money that I'm investing? That's the big question. We already have yeses to the first 2. The hardest one to get the yes for is number 3. And your job is to be patient and wait for the right time to buy, and buy when the stock makes sense. And as it goes lower, you buy more shares. So let's check out our stock analyzer tool. Now, again, guys, this is one part of our software. It was the most popular 1.3 million times last year. It allows us to make assumptions about the future, and then it'll spit out, based on the free cash flow and the earnings, what price to pay for the company today, not including the balance sheet. Now, before we go further, this is one tool of many for our software. We have all these other tools right here. All these tools here are available in our software, including the stock analyzer tool, and more importantly, our community. Thousands and thousands of investors in here that are like-minded. They don't agree on everything, but that's the key. They engage in the same kind of process, because that's what we're trying to do here. We're trying to teach a process. If you have the right process, you can apply it to anything you want. If you're just waiting to be told what stock to buy, you're going to be left alone. So we're trying to teach this process, and this is all available for $1 per day, $7 for 7 days. That's the big thing. Try it out, $1 a day, everythingmoney.com. Check it out. You won't regret it. I'm very, very confident that that you will stick with it from there on out. And remember, every month the price goes up, but you are in your category. With the price you pay, you are stuck in that category for the rest of the time. So guys, let's check out Visa and do a 10-year analysis. You can do anywhere between 1 and 20 years. I'm doing 10 right here. So, revenue growth. The analysts were expecting double digit for the next 4 or 5 years. So I'm going to go low on the middle ones. I'm going to go I'm going to go low on the first one, 6% revenue growth. Because I think the world GDP will probably grow at 6% overall. Actually, you know what? Let me do this. Let me do 5, 8.5, and 12. 12's high, guys. 12% revenue growth is very, very high, but I'm okay with that. The reason I like this tool so much is it allows me to put such high numbers in there where even if the stock doesn't justify that, I can see how expensive the stock really is. And that's really important to me. And I put really low numbers in here because I would sit there and say, listen, I want to see how cheap it is if the low numbers are well within the category, well within the price range for the company. That's what's key there. All right, profit margin. All right, been pretty consistent. The last 10-year average is 47%, but the last 5 years has been 51. So let's go 48, 50.5, and 53. 53 is high. They haven't done that, but let's see if it happens. Free cash flow margin, we're going to do 50, 53, and 56. Because if you look right here, guys, free cash flow has been higher than profit margin. And free cash flow matters more to me than profit margin. Profit margin is based on net income. And profit margin and net income can be affected by accounting rules, GAAP, SEC, all these things. Free cash flow, it's harder to affect this. It's harder to sway this number. It's harder to manipulate this number. So that's why I like to look at free cash flow. Most value investors love looking at the free cash flow because at the end of the day, that's the money left over. And free cash flow is super important. You can do 5 things with free cash flow. You can buy back shares, you can pay a dividend, you can invest in yourself, you can make acquisitions, and you can pay down debt. Those are the 5 things you can do. That's why free cash flow is so important. Now, PE and price of free cash flow. In this metric, I'm sitting there saying, okay, at the end of 10 years, what do I want to assign? What PE and what price of free cash flow do I want to assign? Now, don't focus on where it's at today. Focus on the long-term average and then adjust accordingly. So the long-term average is 15, maybe 16. But as we said before, if they have a high growth rate and or a high ROIC, return on invested capital, you should pay a premium. So for a company like Visa, my low number is going to be 15. Just start out with the low number, but I'm going to go higher from there. I'm actually going to pay a little bit of a, I'm going to go 18.5 and 22. 15, 18.5, and 22. Because if they get 12% revenue growth and all these numbers hit, I'm willing to pay a premium for that. That's established themselves. And remember, when Warren Buffett started buying Coca-Cola, he paid 30 times earnings for that. 30 times. Now, the investment's only made 11% a year, but he paid 30 times and still made 11% per year. And I look at this company, doesn't have a lot of capital requirements, and has a very good ROIC that's probably going to get better. So that's why I'm willing to pay that premium. The last question to ask, what is my desired return? Now remember, guys, this is basically your margin of safety. And you hear that a lot when it comes to value investors. Just like a bridge. If you want a bridge to hold 10,000 pounds, you build it for 20,000 pound support. That way, you'll always hit that 10,000 pound number. Same with investing. We want you to sit there and put a higher desired return. That way, you're going to be wrong because we don't know the future. You're going to get some things wrong. But the more margin of safety you have, you're either going to lose less money or your worst case is you make less money. And that's what's key. So usually on my low side, I'll still put in the market average of 10%. And the reason being is I've already beaten the company up. I've already put a lot of margin of safety in here. So I'm okay just going, okay, I'm fine with 10%. As I go higher, I need a higher margin of safety. I need more return. So 10%, 12, and 14. Guys, the chances of it hitting this is so low, I have to have that big margin of safety. And 14% return on my money is pretty adequate for that. So I'm going to hit the analyze button. Now remember, guys, stick on through to the end of this video because I'm going to add a few more tidbits after this stock analyzer tool. So make sure you stick with us even after I hit the analyze button and explain things. The stock's currently at 226. I have a low price of around 120, a high price around 210 to 220, and a mid price of 160 to 170. Now, here's the key. If I pay today's price and all of my low assumptions occur, I'm going to make about a 2% return. If I pay today's price and all my middle assumptions occur, I'm going to make about 7.9. And if I pay today's price and all the high assumptions occur, I'm going to make 13.69. That is the power of this tool.